Good afternoon, everybody. My name is Evan White. I'm the Executive Director of the California Policy Lab. We are a nonpartisan research center based at the University of California that works to improve the lives of Californians by generating evidence that transforms public policy. We work in areas such as poverty and economic inequality, homelessness, criminal justice reform, and education inequality. And today we will be focused on one aspect of our work, and I'm thrilled that Rich Cordray, prior director of the CFPB, is available to join us today to talk about the role of consumers in the economic recovery. Welcome, Rich.
My pleasure, Evan.
The idea for today is for this to be an intimate conversation to leave plenty of time for questions from the audience. So for the first half of our time, Rich and I are going to be discussing consumer economic recovery. And for the last half, we're going to open it up to questions from the audience. Some of you, thank you, have sent them ahead of time. If you have others throughout the time here, just chat them to Pam Seidenman, our development director. And we'll call on folks and you can unmute and ask your question live. A couple housekeeping notes before we begin. One is to please stay muted while others are talking. I appreciate that. We have a esteemed audience here today, so if you wouldn't mind introducing yourself in the chat feature. I see a couple of old friends from my days at the Consumer Financial Protection Bureau. Ellie Bloom, who's a Special Assistant Attorney General at the Department of Justice, working for, I guess, the new HHS Secretary. Irina Aspenson, who's the Chief Economist at the Department of Finance. Thanks for joining. And several others. So please introduce yourself in the chat if you don't mind. Lastly, the emergency exits are at the back of the Zoom room, and undoubtedly there's a lavatory within hearing distance. So feel free to use that at your leisure. So let me start with a brief introduction of Rich. He was the first and the best director of the Consumer Financial Protection Bureau, where I and some others in the audience worked alongside him. He also has a long history of public service in Ohio before that, including as the state's Attorney General, the state's Treasurer, the state's Solicitor General. And I understood he ran for governor, and they're still counting the votes, right, Rich? You're contesting that election still.
I must say that I sportingly conceded some time ago.
I haven't heard of that. And he clerked for not one but two Supreme Court justices, and has argued many cases before the court. Most importantly, as far as I'm concerned, he was a 5-time Jeopardy champion back when they stopped you after you won 5 times. So welcome, Rich. Thank you for joining us today.
My pleasure. They called that term limits, I think, on Jeopardy.
Yeah, another outdated concept, but we'll soon get rid of those. So let's begin with the current recession. So the CFPB was started after the last recession, in large part because of the last recession, which was very different in nature, right? So that recession coincided with these twin crises in the housing sector and the financial sector. And those with home wealth or stock investments were hit quite hard as a result of that recession. And it had larger repercussions throughout the economy. By the numbers, this recession is actually far larger. So according to a recent California Policy Lab report, nearly 45%, which is a huge number, of California workers have applied for unemployment since March. But outcomes are diverging, sharply between those who can work remotely and the largely low-income workers whose work requires in-person interactions, like the service sector. Moreover, this recession was entirely created by COVID-19 and the pandemic, which makes it sort of different because it's possible, at least, that after the pandemic is over, which hopefully will come sometime soon, that employment and economic activity could come roaring back. So I guess my question for you is, in terms of household finances, how is this economic recession different? Do you think that consumers are in a good position to recover once the virus is beat?
So it's an excellent question. It's actually a question to which I devoted a community address at Boston College Law School earlier this semester, where I spent 45 minutes dealing with that question. So I will abbreviate that today, but it is kind of fascinating to dig into the financial crisis of 2008 and the COVID crisis, if you will, of 2020. I remember so often saying at the Bureau that we had faced and confronted and were addressing the worst economic collapse of our lifetimes. And we had seen nothing like it for 75 years since the Great Depression. And certainly we all hoped and thought that it would be the worst economic crisis of our lifetimes. There are measures by which the current crisis is worse in terms of the sharp drop in GDP last spring. Certainly that was worse, although, as you say, very different causes and a very different economic situation going into this crisis. I mean, this crisis was, uniquely self-induced by the government to try to address a non-economic concern, at least initially non-economic, the pandemic. And they shut down the economy in various ways that led to the problem. Typically, a downturn in the economy is foreshadowed and in fact caused by some sort of malignancy in the economic conditions themselves, such as the mortgage market meltdown in 2008 was the precursor to the financial collapse, and ultimately the widespread unemployment, widespread foreclosures, which again were a unique phenomenon because of the mortgage market problems. And as you say, notably and interestingly, we will see what the ultimate upshot is. This economic crisis was not foreshadowed by any particular imbalance in the economy that everybody always is predicting some sort of recession here or there. But there was no particular weakness in the economy that led to this current recession. It was the shutdown of the economy, and again, induced by government policy itself, not government policy that we're familiar with, such as raising interest rates that leads to heightened unemployment, but the actual shutdown of the economy. So one of the things that is unclear at the moment is what the trajectory of the crisis will be, in part because there was such a dramatic response by the federal government in terms of fiscal stimulus as well as monetary stimulus. There was also a significant monetary stimulus response in 2009, 2010, but there was something of a fiscal stimulus response, but it was cut short in that era, and it was blocked from any kind of further stimulus, and it was held under $1 trillion total investment, and the investments were of a different kind. Many of them were longer term projects. This time, under the CARES Act, learning lessons perhaps from the last crisis, much more money was pumped into the economy by the Congress, a couple of $1 trillion more actually, and the Federal Reserve far more. And it got into the hands of people on Main Street as opposed to simply Wall Street through stimulus checks and enhanced unemployment benefits. The odd result of that, as some of the bankers have noted, is that we have a recession like we've never seen before, where we had high unemployment, and yet we had average household income across the country actually rising at the same time. And that certainly was true through the spring and into the summer. Now that has begun to subside as the stimulus has worn down, as the enhanced unemployment benefits have begun to go away, as the effect of the one-time stimulus checks has faded, and so on. But what we don't know yet is if we have flattened the curve of the economic collapse, just as we were seeking to flatten the curve of the COVID pandemic itself, what the longer-term effects will be once we go into the new year, particularly if we don't get more stimulus. And there already is a backlog of potential evictions, potential foreclosures, people with unpaid bills, and the like. And we don't yet know what the effects of all of that is going to be. So it's interesting. And it is difficult from a policy standpoint, but everybody who has looked at it closely is in agreement that more fiscal stimulus would be needed. And also, by the way, it is deserved because nobody can suggest there was at least fault that could have been found with people in the financial crisis of 2008. Investors were at fault, rating agencies were at fault, even consumers were at fault at times for getting into bad mortgages that they maybe should have known better. Sometimes it was predatory, sometimes it was misleading, deceptive, fraudulent in various ways, but some of them probably should have known better. Nobody here stopped working because they suddenly got lazy or complacent or decided they wanted a vacation. They were forced to stay at home. Their businesses were forced to close temporarily or longer term. And there is no fault to be found with the American public. And that been a stronger basis for a rationale for more intervention. But it's also a rationale for more intervention now still as the effects of the pandemic are being felt. And in many ways, they are growing and expanding as we speak.
You mentioned the that some of the aspects of this recession may have yet to hit, which is part of the scary piece of it. So I'm thinking here about the eviction moratoria that have been in place in various places, but that could expire. Also the expiration of various unemployment benefits. I think it was yesterday, Moody's Analytics put out a report saying that 12 million renters owe an average of $6,000 in back rent. And millions could be evicted in the months to come, probably exacerbating a homelessness crisis that, at least in California, is already quite severe. One solution is to use sort of existing safety net programs that help households rebound. But what we found is that a surprising number of people who are eligible for public assistance benefits don't take them up, either because they're unaware or they think there's a stigma associated with them, or because the process of applying and staying on these benefits is too complex or too burdensome. And the Policy Lab has actually done some fascinating work on this. So we looked at trying to make it easier for households to claim the earned income tax credit. And by the way, the stimulus checks as well, if you didn't file taxes in the last 2 years, which many low-income consumers are not required to do, you didn't get the stimulus checks. And that was probably, at least in California, sort of a large number of people amounting to several $million. And we're about to put out a report that shows that several 100,000 food stamp recipients actually leave the program each time they have to recertify their eligibility, even though we can see that they're income eligible after they leave. So I guess in thinking about how to get folks onto benefits for which they're eligible, I'm curious about your time at the CFPB and what you learned about how to convince consumers to do things that were in their financial best interest. Like making a budget or saving money or not taking out a loan that they can't pay back. Any lessons there?
Yeah, but it's a great question, although I would start my answer to the question in a different place from the way you posed it. I would point out that many of these benefits are not taken up by consumers, in part because governments make it difficult for consumers to take up and sustain these benefits over time. And there are a lot of reasons why government may do that. Of course, there's certain hostility among a number of public officials to government benefits at all. They don't think that there should be benefits or that they should be as generous as they are. And they are quite willing to work in various ways, often below the radar screen, that make it difficult for people to collect those benefits. There's also a great concern about fraud, which is a legitimate concern, but often overstated, so that people do have to reapply fairly frequently sometimes for these benefits. It's one of the things that's helped defeat the effectiveness of the expanded Medicaid programs in the states, because people will often fall off of eligibility, and then it takes several months for them to become eligible again, or for their eligibility to be determined again. And so people end up with just a few months of eligibility and then a long period off, and so on. My background here really that I would draw on is less the federal government at the CFPB than when I was in state government. In Ohio, we actually had started to create what we called the benefit bank. And the concept was that instead of seeing all this public assistance as welfare, we should regard it as investment in people. And just like any other bank, it should have the stigma taken out of it as much as possible. And more to the point, that the benefit bank would be a place where if you tried to sign up for any sort of government benefit, they would try to assess you as a one-stop measure for all possible benefits that you might qualify for, which makes a great deal of sense. I mean, one of the difficulties of these programs is simply you have to apply for each one separately. You have to apply for Medicaid, you have to apply for SNAP, you have to apply for utility assistance or housing assistance. Suddenly, the notion that the average consumer, and particularly the average consumer who's living at the margin, and often, not well educated and not all that comfortable with or knowledgeable about the ins and outs of government, is expected to be some sort of administrative expert at dealing with all of these forms and dealing with all of these processes, is a really unrealistic expectation. And yet, for a lot of people in federal, state, and local government, that process works pretty well because the benefits don't get drawn down and the programs are not being demanded as much as they could be, and the spending on them is reduced. The potential spending is much greater than the actual spending. And so I would say that one of the places we need to start is by thinking about what it is like for an individual to apply for different government assistance, the social safety net. It's not that it just magically appears for these people most of the time. They have to go through various hoops to justify it. And if we could make those hurdles lower, and if we could make those processes easier, what we do know is that every time you put up a new hurdle or a new obstacle, some number of people will fall off the train. We saw that in the consumer world in a very different setting. These interest-only products where you buy a big screen TV and you get offered a new credit card with 0% interest for the first year. They don't offer that complicated product just because they're feeling generous. They offer it because they know that a number of consumers will somehow fall through the cracks on that and end up being dinged for the entire amount of the interest that they were supposed to be able to defer because they didn't meet various procedural thresholds. And you might say that the same is being done intentionally or unintentionally. It often doesn't really matter to the effect on the consumer through these processes. So I would say there's much that the Policy Lab and others could do to think about how to improve the processes to access benefits and lower the hurdles. Another analogy I would make is with retirement, individual retirement accounts and other 401ks. We have found that when you make it possible for people to be put into those programs when they sign up as a new employee, rather than having to opt into the program, they actually have to opt out. And if the levels of takeout from their paychecks is set appropriate to their financial situation, they will tend to defer to that and not change it in some other way. Those are the kinds of public policy measures that can make a real difference to the financial trajectory of people.
Yeah. I think that's a good point. We're actually, with the Policy Lab, exploring some of those kinds of ideas with the agencies that we work with. So we've been looking at whether it's possible to kind of pre-fill earned income tax credit claiming with some of the data that's already available within government. There's also been some conversation around whether FAFSAs, which are very complicated. I know your kids are in college right now. Your twins, both in college, very complicated forms to fill out, and yet most of that information is already in taxes that everybody fills out, and so could be quite less complicated for the average consumer. But there is a goal, I think, in sort of making these things complicated, that people have put that in place as a way to try and make sure that you have to work for it, and
yeah, I think that's true. Some of it, though, is just a matter of historical accident. I'll give you another example. When I was the Attorney General of Ohio, and we were concerned about the problem of worker misclassification. I know California has been debating this around the gig workers, but there are certain companies that deliberately misclassify their workforce as independent contractors so that they don't have to pay into the unemployment compensation system. They don't have to pay into the tax system and do the withholding. They don't have to pay in to the workers' compensation system. It's a big savings for them, but it comes at the expense of arbitraging the system, and it costs state and local governments and the federal government quite a lot of money. What we found was in state government, just because each part of the state government operates on its own, the unemployment fund, which was part of our Jobs and Family Services Department, they would occasionally investigate companies for doing this. The Department of Taxation would occasionally investigate companies for doing this, and the Bureau of Workers' Compensation would occasionally investigate, but they didn't join together and work constructively and cooperatively. I, as the Attorney General, put all of them together. That gave us a larger force of investigators. If somebody was cheating one of those areas, they were cheating all three. There wasn't any mystery about that. And we were able to bring a number of actions to help clean the problem up, but it's just a matter of siloed, historical, localized thinking. And if we thought more about government benefits as a overall tapestry rather than each individual thread, I think we could do a lot better by these people and again, make the processes easier and have a more holistic approach.
So I noticed behind you is your recently published book, Watchdog.
It just happens to be there, Evan. Yeah,
yeah, I know that it's a real coincidence. It's a real page turner. I recommend it to those folks in the audience. And in it, you talk a lot about the founding of the Consumer Financial Protection Bureau and its first several years. As I think you know, this past legislative cycle, California established something similar to that called the Department of Financial Protection and Innovation, which is actually kind of a redux of the existing DBO, Department of Business Oversight. Why is it necessary to have something like this at the state level in addition to the federal CFPB? And what do you think is the role for states in protecting consumers, especially as we sort of come out of this pandemic and recession, the related recession?
Yeah, sure. And by the way, I would reverse the presumption of the question. Why shouldn't California be focused on protecting its own consumers, regardless of what is happening off in Washington, D.C.? And why shouldn't we in America have robust protections for consumers at the state level, even at the local level in some ways, they can be helpful, as well as in the federal government, and have both levels of government work together to look out for the consumer. I think it's well known that these laws often are under-enforced, that there are various impediments that companies have raised to having their accountability imposed by anyone. And as a result, we can actually use the federalist system to our advantage by having robust protections at the state level, where the government is closer to the people and maybe can deal with more idiosyncratic or localized problems, and the federal government, which is less close to the people and often works at a higher level of generality and volume, but can team up with states and be effective. One of the things we did at the Federal Consumer Bureau was we worked closely, as you know, and as Ellie knows, with state attorneys general and state financial regulators. And what you're talking about here is the California financial regulator restyling itself as opposed to being a business department about the businesses themselves to being a consumer and business department, but focusing more on protecting consumers as a goal and as a mission. And I think that that's appropriate. It's more of a balanced perspective. And I think that that'll be beneficial. And I, as you know, I work closely with the big coalition of consumer groups in California to work to get that passed. We had great help from the Attorney General's office and Ms. Bloom, who's on the call here today, who was the person who liaisoned with the DBO and with these groups to help us get that through the legislature. And we had great support from Governor Newsom, who was courageous, I think, in really pushing this forward at a time when it could have easily been said, Number one, you don't need to do something like this. And number two, you certainly don't need to do it during a pandemic. Change is always hard. Let's not make any waves. Let's not rock any boats. But the legislature did create that overhaul. And I think that now in California, you will have the ability to go to the state government or the federal government and seek protections. And I think that there will be many ways that the new DFPI can work closely with a rejuvenated CFPB under President-elect Biden and his administration to really make some progress for consumers in ways that we haven't necessarily done as well as we could in the past.
All right. Well, any mistakes that the CFPB made that you would unsolicited advice have them avoid?
Well, there's a number of things that I think we could have done better. There's many things that I think we did extremely well. Much to be proud of at the CFPB for its first 6 years, and many of us have looked on with gnashing of teeth to see the leadership under the Trump administration reverse some of those efforts and cause others to fall into neglect or decline. But what was done before can be done again. One of the reasons I wrote the book Watchdog, which you see over my shoulder, was not just to tell what I thought was a fascinating story of building a new government agency to address the problems of consumer finance and the importance of those problems across this country, and not just to talk about what we did during those first 6 years, but to explain why we did what we did, to talk frankly about some of our mistakes, to make a point of the things that we did well, as a roadmap to what can be done again in the future. And it can be done easily enough under new leadership there. And I believe much of it will be done. And so I'm quite optimistic that the Consumer Bureau will be a big plus for middle and working class Americans again, in a way that it wasn't nearly as it could have been for the past 3 years.
Fair enough. So I'd like to transition. I have a couple more questions if the audience is unexpectedly silent, but I want to transition to the Q&A portion of the program. And just as a reminder, to ask a question, you can either put it in the chat or raise your hand and we'll call on you. And I wanted to start with a question that was sent in advance by Irina Asmunsen, who's the chief economist at the Department of Finance. It's about a bill that recently passed that transforms back rent into consumer debt rather than allowing landlords to evict for that back rent. So Irina, would you mind unmuting and asking your question in more detail?
Yeah, so we extended the eviction moratorium in California. And we said that non-payment of rent, as long as tenants paid at least 25% of rent from September through January, the remainder of that turns into consumer debt, which is only collectible in small claims court, and it's not grounds for eviction. So, starting in February, you are going to have to sort of pay your rent in full, and hopefully we're going to get some federal stimulus money or extended unemployment benefits to do that. But there's going to be a whole new class of consumer debt. So we're a little bit worried about this. We've heard that normally landlords just sort of write this stuff off, but this is going to be a much larger class of debt. So it's a new thing. Any lessons from your experience at CFPB that we should put protections on this kind of consumer debt?
Yeah, I actually think we should be very worried about the eviction cliff that we're about to hit. And of course, it's hitting at different times around the country because most of the rent and eviction measures, the moratoria, were imposed as a matter of state or local law, or imposed by the courts themselves who stopped hearing those cases for a period of time, sometimes on the rationale that they didn't want people to have to leave their homes and come down to the court over a matter of that sort when they were supposed to be sheltering in place. Anyway, there's been good reason for that. One of the oddities about the Consumer Bureau is that it's a bureau that deals with issues of consumer credit. And there are definitional issues that sometimes seem odd or not sensible that affect its jurisdiction. For example, the difference between owning a home, typically one that you purchased through taking out a mortgage, and renting a home or an apartment where you don't take out any sort of credit, but you simply pay as you go. I think for most people, the difference in the payments that they make each month, either on the mortgage or on their rent, isn't much of a difference. They know that it's an important payment. It's one of the biggest payments they make. Their housing depends on it, and therefore the stability of their home situation depends on it, and they make every effort to make that payment. However, because on mortgages, you're repaying credit that was extended to you, that's covered by the CFPB. When you're a renter and you're paying month by month, that is not considered credit, and it's not covered by the CFPB. And that's one of the reasons why a lot of these measures had to be put in place at the state and local level. But as you say, this is going to be a significant problem for consumers, a huge problem for consumers. I mean, Evan noted earlier that the study that just came out, I think it was 12 million Americans owe an average of $5,800 a piece in back rent. They're not going to be able to pay that. If they weren't able to pay that all along, they're not going to be able to pay that in a lump sum. And many of them are going to be dumped into evictions and ousted from their housing if the courts and the laws begin to allow that again. At the same time, landlords are in a very difficult situation as well. They're in this position of the mortgage holders. They're the ones who are owed the money. Many of them are not, they're not deep pockets or bottomless pockets. And if they're not getting paid the revenues that they expected on those investment properties, they will potentially be in danger of being foreclosed upon themselves. So typically what you need, if you're going to give relief to consumers, you can give it to them directly. You can also give it to the landlords, who are the ones who have to finance this relief for consumers. But there has to be something there in order to make it work. Right now, we're simply deferring the problem. That's the best we can do in the short run. And we're deferring it during the pandemic, where, by the way, the last thing you want is for people who are either being ordered to stay at home or out of prudence are staying at home as much as they can and should, because they don't want to expose others and themselves to the virus, are suddenly having to move their housing. I mean, this is supposed to be their safe place, the place that they can shelter, the place they're being expected to shelter, and it's being taken away from them. That is not logical, and it's why we've had these moratorium in place across much of the country. And we are not ready to have those taken off yet, I don't think. But we have to have some financial help for consumers and or for landlords, and probably for both. And I'm not quite sure that the current Congress is grasping the magnitude of that problem. There seems to be, at a time when we've sort of set aside concern about deficits temporarily, there seems to be now a newfound view that we're going to have to hamstring ourselves just at a time when we may be coming into the last 6 months or so of this and coming through it. It would be an awful shame to see so many people dumped off the cliff just at that moment of truth.
That actually ties in well with the next question, which comes from Bob Crittenden, who asked a question about pacing and sequencing the economic stimulus with the vaccine. Bob, do you want to unmute and ask your question?
Sure. Thank you very much. I think I'm pretty clear what the feds could and should do, but we're at the state level, at least I am, and we're trying to decide what steps we should take. Right now we're just trying to, plug holes and keep people alive and working, but I think, we have to think about going forward. What are the steps you think would be most effective as we waiting for the vaccine to get our economy going? Not just, obviously we have to control COVID, but we also have to keep our economy going. What thoughts do you have about next steps or sequencing them?
Well, look, first of all, and let's be blunt, there's been an extraordinary failure of leadership at the federal level all along in this crisis. The Congress did pass the CARES Act, and the Federal Reserve has opened the spigots. That's important. But clearly, until we get the pandemic itself under control, we're just managing a horrible situation. And the federal government under the Trump administration has done a poor job. In fact, absent without leave, as best I can tell, for the last several months in terms of addressing the pandemic. And the notion that there's this false notion that there's this choice between reopening the economy and battling the pandemic, when clearly you can't really have the economy working until you've battled the pandemic effectively, because even if you take off stay-at-home orders, people aren't going to be comfortable going out and returning to their normal patterns. You can't just make them do that. And good sense dictates to a lot of families and individuals that they don't feel comfortable doing that. And workplaces are affected as well. So what we need is a better way to find measures to address the pandemic within the context of an economy that works as well as it can. For example, things like pickups rather than in-person dining. Many other ways in which this is playing out in a strange pattern of this COVID economy. But we have to try to do both things. I don't think we can just shut down the economy again. But I also think that unless people are willing to or being mandated to, and they need to be mandated, I think, to mask, to observe social distance, to do the hand washing, you can't operate businesses safely in the meantime. So it is a dual strategy. It is trying to mitigate the economic effects while trying to address the pandemic. And until you can do both, both are going to be harmful to many people. Now, as to what you can do at the state level around this, when we're not getting cooperation from the federal government and they're not exhibiting leadership, many governors have had to step up and do a lot of things that are unusual, but have been unavoidable. And there's been a lot of dissatisfaction among some members of the public about that. But what do you want here? I mean, we have people at great risk of getting very ill and dying. It is spreading, rapidly throughout our country right now. And if it can operate, either by causing people to become sick and to die, or it can operate by causing people to become financially ill and be affected. And there's no magic answer to how we get back to where we are, but it's certainly the sooner we contain the pandemic and extinguish it, the better off we'll be. And in the meantime, we're just managing the crisis as best we can.
Thanks. Let me just see if there's anyone from a show of hands who has a question. I have a couple others from the audience.
Can I ask a follow-up?
Sure, go ahead, Irene.
Which is about this entire federally backed mortgage deferral, which, I think for economists, one of the things that we regretted during the last crisis was that all of this assistance to banks didn't somehow make it to consumers. And so, we really want to help the people, not just the big banks. And so, there has been a lot of assistance given in terms of these mortgage deferrals to landlords. And so then why should we help landlords more when their costs just went down by a lot? Any reactions to that, or, are you?
Well, wait a minute. We're talking about two different things here. We're talking about mortgage assistance, and we're talking about rent and landlords. Okay, so two different subjects, obviously closely related. One of the lessons I think we did learn from the last crisis was that simply pouring money into the banks and the financial companies doesn't mean that you can count on it getting to the public. In fact, that was the last sort of plaintive line of The Big Short, the movie The Big Short, was, essentially the money had gone to the banks and, they'll lend it out, won't they? Well, no, they didn't lend it out, much of it, and it got stuck there. Now, one of the ways it seems we've learned from that is the CARES Act did send money directly to a lot of people that didn't get it the last time. There were stimulus checks the last time, but they were smaller than they were this time. By the way, there's been talk of a second stimulus check, but now it seems like that's being being set aside in the interests of greater financial short-sightedness, frankly, if you want my view. And we had the enhanced unemployment benefits, which have been extremely helpful. And we've had the PPP program, which has gotten money to a lot of small businesses. By the way, one thing I'm not clear on is how much, if any, of that PPP money went to tenants who are small business people renting to, that is, landlords renting to tenants. It seems to me they should be able to qualify for the PPP funds, and that gives the kind of financing that would allow them to help carry more tenants through the crisis. So that's a place where I think this is important. But there has been a better job of getting money out to Main Street this time, but there's still a lot of money pouring through the Fed to the bigger banks, the bigger companies. By the way, there was a really bizarre exchange I saw on this a few months ago. It was a time when the airlines were pressuring Congress for more bailout money for the airlines. And there was an exchange on one of the business channels where they were talking to the CEO of one of the major airlines. And they said, well, I guess you need more money to be able to maintain the workforce. And he said, well, we actually have plenty of liquidity, but we really think that we should be getting the bailout money so that we can preserve our workforce. And if you stop and take that apart, they have plenty of liquidity, then can't they finance the workforce? If they didn't have, why do they need the money if they have enough liquidity to finance the workforce? What they want, they just simply want more money, more than they are entitled to, and they could hold their workforce in place. They just wanted, they had their hand out. And I think that the same has been true with some of these programs. But for the most part, we've done a good job of getting more money out to people. But now we're at a crisis where we need a second round of that. And it's unclear whether Congress can deliver it or deliver it adequately. And that's a big problem.
Jesse, I see Jesse Rothstein has his hand raised, a professor of public policy and former chief economist at the Department of Labor.
Thank you. I wanted to move a little bit away from the COVID crisis, as important as that is, and talk about something that's very central to what the California
It almost sounds like
is.
a heroic thing to say. I'd like to move a little bit away from the COVID crisis.
Well, yes, I'd like to do that too.
But in any event, feel free.
Yeah.
Apparently, a lot of people in California are moving away.
But they're not moving away from the COVID crisis, by the way. Yeah.
Nope,
So we're all about something you mentioned about kind of bringing together data from different public programs to make sure that we kind of can cross-reference that information and make sure people are getting the benefits they're eligible for. But when that kind of data linking happens in the private sector, I think we worry about the way that it'll be used. It'll be used to grant or deny credit to people based on things that are irrelevant and in some cases kind of biased measures. So, or even if they're unbiased, they're not necessarily fair. Do you really think that you should be denied access to a credit card because you got suspended in 8th grade or something like that? And I guess I wonder how you think about the kind of trade-offs and whether we should be worried about doing this in the public sector the same way we are in the private sector, or whether what should be the ground rules for kind of bringing together lots of irrelevant data or seemingly irrelevant data to kind of feed into learning models to design who gets benefits or who gets credit cards or mortgages.
I'm not sure I follow the question, but let me try to unpack it a little bit. What you're talking about in the private sector is decisions about whether to extend or deny credit to people. And there could be lots of factors or extraneous or facts about people that some of them would be appropriate, some of them would be inappropriate, and they might be misused. What I'm talking about, though, in the public sector is just this. You typically have to fill out forms with about the same kind of information, name, address, background, employment history, et cetera, financial situation, for various different benefit programs. And at a minimum, those common fields ought to be able to populate across different agencies, or you should fill out one form, I'll call it a universal form for government assistance, and then they ought to take it and make the decisions about whether you're eligible for these benefits. but it's not like there would be inappropriate criteria, I think. It's just that there could be a much greater efficiency and not making people have to apply to 4 different places in 4 different ways, much of which may be common, by the way. It's just, it's like in the Wizard of Oz when the wizard tells them to go fetch the broomstick of the Wicked Witch of the West. I mean, they've already done all kinds of things. Why do they?
I think that
they don't even know. They don't even know often exactly where they're supposed to go to get these different things.
You're definitely preaching to the choir here. I'm 100% on board. When I was at CEA,
but I don't think it poses the risk that you posited. I think that's a different setting.
Yeah, I guess what I worry is that there is a tendency that once we have all this information collected, then, well, why don't we use it? When we're deciding who should get a student loan, why don't we look at how much they've drawn on public benefits or other things in the past?
Well, that's a different issue. That's a different issue. My point was simply that the information needed to help you qualify for benefits, there should be much easier processes about that. It's a different issue, and as you say, it's a meaningful issue that if you've received government benefits in the past, should that somehow disqualify you from something else? That's the reason why the Federal Equal Credit Opportunity Act has made it illegal to discriminate against somebody in offering credit based on the manner of recipients of receiving income. So that, merely the fact that you've been on public assistance is not a reason to deny you credit, but you should treat that income like all other income. That's a different matter. That's a private sector matter, not so much a government matter. If your point is that there are going to be programs in the government that are going to say, well, they already got Medicaid, so they shouldn't be eligible for food stamps. I don't understand that. I mean, the eligibility is based on the income criteria and so forth. I think there's plenty of people who fall off and don't get benefits because of the difficulty of applying right now. I'd love to be, throw me in that briar patch to have the problem be that it's easy to apply for all these benefits and then the government's having to decide maybe you shouldn't get all 4 of those things. You should only get 2 or 3 of those things. Although there too, unless they're going to violate the law, they should have to rethink their programs, not apply artificial filters to stop people from getting into them in the first place. I'll give you an example. When I was the Ohio Attorney General, we had the ability to take complaints from the public, as pretty much every government agency does, as you know, and yet the organization had decided in its wisdom that if somebody now wanted to file a complaint online, the first thing they would do is receive the complaint and then send you out a paper form in the mail that you had to fill out on paper and send back through the mail in order for it to be an official valid complaint. That was simply done, either it was mindless repetition of the past, or it was simply done to knock down the volume of complaints and make it more manageable for the government entity. That's the kind of thing I'm talking about here. It's a different issue. I understand, maybe I understand your issue a little better. If somebody already qualifies for Medicaid, are they more likely to then be denied, food assistance? I don't see why they would. I don't see why they should. And if that is an issue, then state law ought to be amended accordingly. But I think that they're separate issues.
We're just about at time, and Rich and I will stay on for a few extra minutes in case there are other questions, which I see.
Oh, will we? Okay.
But before we wrap up, I wanted to take a quick minute to thank everybody here for sharing your lunch break with us and being such an attentive audience. I also wanted to thank some of our supporters, including the Laura and John Arnold Foundation, the James Irvine Foundation, the Hilton Foundation, and the UC Office of the President, without which we couldn't do programs like this and our valuable work. The California Policy Lab is funded by philanthropic support of folks like yourselves. So if you are so inclined, we would love for you to consider a gift to the lab. Our Director of Development, Pam Seidenman, will be following up to see what you thought of today's conversation and any interest you might have in those issues. And so thank you all for joining us, and we hope to see you at future CPL events. Again, Rich and I will stay on and field any other questions from the audience. Thanks so much and have a great rest of your day.